It is finally 2024, and after a great year on the market in 2023, it's time to think about what portfolios should look like in 2024, where there's going to be investment opportunities. And so today, I want to lay out my 10 favorite stocks going into the year and also four investing themes. Because if you look back at 2023, it was kind of a strange year. It was dominated by the Magnificent Seven. The rest of the market didn't do particularly well until the last 6 or 7 weeks of the year. So going into 2024, I want to look at where there's actually strength in the market, not just hype, but actual operational strength. So that's going to drive a lot of the themes that I'm going to talk about, and then where I think there's a lot of performance and value in the market in the 10 stocks I'm going to cover. Before we get going, I want to remind you to subscribe to Asymmetric Investing. It really helps out the show, and share this with anybody who you think would be interested. And I want to thank this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they're going to give you their top 10 stocks to buy right now. I'll highlight their performance in just a little bit, but that is another great place to look for great stock ideas for 2024. So I want to start with my four themes for the year. And this goes to both opportunities and risks in the market. I'm going to bring them all up right now so you can see them. But the four that I'm looking at start with artificial intelligence. AI was really the theme for 2023. And if you look at the stocks that did really well, particularly those Magnificent Seven stocks, there's an AI angle to almost every single one of them. Either they're making chips, or they're making models, or they have valuable partnerships, or there's some sort of hype about a product that's coming in the future. But as 2023 wore on, I think it became more and more apparent that the future of artificial intelligence may not be as valuable as a lot of people thought. And I want to go through just a quick overview of that. If you think about the three pieces of artificial intelligence, you have the chips who are doing both modeling and inference. You have the models themselves, and then you have the applications that people are actually interacting with to use artificial intelligence. And I think there's a case to be made that in all three cases, we're going to see commodification and value destruction in all three parts of the value chain. Start with the applications. We saw throughout 2023 that as soon as somebody came out with something interesting and valuable, whether that was a large language model or an application like ChatGPT or an image generation tool, it would simply be copied by everybody else. And now you can find chatbots and image generation tools all over the place from all kinds of big tech companies and startups. And there's not a huge differentiation between any one of those different applications. A lot of them are even using the same foundational models to do what they're doing in artificial intelligence. So I don't necessarily see where the value add is and where the incremental new revenue is for a lot of these companies. And we've seen this over and over again. In the startup world, we've seen artificial intelligence tools skyrocket to billion-dollar run rates only to see revenue drop through the floor. I think part of the challenge here is that anything that becomes valuable short-term could be undermined by somebody else long-term. I call this the scorched earth strategy. A company that has done the scorched earth strategy in their business extremely well is Google. You think about search, that is really their moat. That's where they make the most money. That's where they have their competitive advantage. And so they want to scorch the earth around them, make everything around them less and less valuable. So you give away email, you give away word processing, you give away cloud storage. These are all products that other businesses were making money on. But Google says, hey, we're just going to give these away because we don't want those to be the valuable part of the value chain. And so many businesses are making so much money elsewhere that they can just give away pieces of artificial intelligence. Google wants to protect search, so they'd be happy to give away chatbots or AI tools in word processing if you just continue using their search engine, giving them that data. There's examples of this all over the internet. So I think that's going to be a very difficult place to add value. We see the same thing in large language models or the foundational models. The example here is Meta. Meta isn't going to make money on their models, so they're just giving them away. They're open sourcing them, allowing anyone else to build on top of them. That's going to mean that the models from OpenAI are less valuable. The models from NVIDIA are less valuable. And we're already seeing that commodification of models because there's not a huge difference from one model to the next. Chips is an area where we have not seen commodification yet, but I think that's coming. NVIDIA is clearly the leader, but Google is coming after them with their tensor processors. Amazon, Microsoft, AMD, everyone is building artificial intelligence chips. They're going to first compete on price, but then you start to compete on technology. And that I think could be value destructive for investors who are overpaying for artificial intelligence stocks right now. So that's one thing I'm staying away from. That's my caution point for 2024. One positive, and something I'm going to be leaning into in the stocks that I talk about here, is horizontal business models doing much better than vertical business models. What I mean by that is a lot of the last decade has been dominated by companies integrating vertically. Apple's a perfect example of this. They sell you an iPhone. Now they want to add apps in the App Store. They want to add cloud storage. They're going to integrate in their devices. So they're developing their own chips. They're creating an ecosystem. They want you to be in it the entire time. Microsoft does the same thing for business. Meta is doing the same thing in shopping with its social networks. They're all integrating vertically and just adding pieces that add value to that vertical integration model. But businesses work in cycles and business models work in cycles. So while integration was the theme over the last decade, I think the next decade is going to be about modularization and horizontal business models. So what exactly does that mean? A horizontal business is one that works across different devices. Netflix is a perfect example of this. Remember when Netflix started streaming, one of the things you saw pop up was there was suddenly a Netflix button on almost every remote control for new TVs. Why did they want to do that? Because they wanted you to subscribe to Netflix, whether you had a Samsung TV or a Sony TV or an iPhone or an Android device. They were a horizontal service. So they had to work on every single device. This is going to be a theme I'm going to talk about later, but companies like Spotify and Peloton are leaning into that horizontal business model. So I think that's going to be something that's going to be a point of strength for all these companies because ultimately the market is bigger. There's more potential users if you're not locking yourself into one ecosystem, if you're trying to serve everybody in the process. The third theme is that cash is going to be king. Cash is going to be more and more valuable as interest rates are up. Investors are more discerning about where they're investing their money. You saw a lot of those hype companies that were really popular in 2020, 2021, never turned around and got profitable. And then their stocks plunged in 2023, despite the fact that growth did really well. And the simple reason for that is that investors are valuing fundamental strength. Cash is king, free cash flow is valuable. And so one of the themes that I'm looking at is the stocks that I invest in, I want to over-index on stocks that have strong financial foundations, strong balance sheets, and strong cash flows. This isn't a one-size-fits-all rule, but this is going to be, again, a general theme for 2024. Is the companies with more cash are going to have more optionality and more strength in the market. And the fourth thing is simply to expect the unexpected. We came into 2023 thinking that a recession was inevitable. It never happened. People didn't see the rise of artificial intelligence 18 months ago. So what's going to happen in 2024? We simply don't know. A lot of the predictions from Wall Street right now just look exactly like what happened in 2023. They think there's a low chance of a recession. They think that big tech stocks are going to do really well. Guess what? They're just repeating exactly what happened in 2023. So we need to be prepared for that unexpected, whether that's a recession or rising interest rates or falling interest rates or rising unemployment. There's going to be a lot that happens in 2024. So investors need to be flexible and be ready to pounce on opportunities when they arise. With that, I want to get to my 10 stocks. I'm going to start this list with Spotify. I alluded to Spotify earlier, but I just think there's a lot to like about this company right now. I'm going to go to the most recent presentation because I think this at least highlights some of the momentum with the company. So remember I talked earlier about horizontal business models being one of my themes for 2024. And Spotify is a perfect example of that. If you are a Spotify subscriber, you can listen to Spotify in your car, on your device, no matter what it is, on your home device, whether that's Alexa or HomePod or a Google device. You can listen to it on your TV, literally anywhere. That's their goal, is to be absolutely anywhere you want to listen to music, podcasts, or audiobooks. And so the progress that you want to see from Spotify is a growing user base. In the most recent quarter, so this is Q3 2023, the number of users was up 26% to 574 million. They are on their way to having 1 billion users in the next 3 to 4 years if this growth rate continues. We also see an increase in premium subscriptions. This is just a single quarter, but 2.9 billion euros, up 10% from a year ago. They're adding a lot of subscribers in some of the low-cost markets. So Latin America is a big growth area, not quite as high priced as the US or Europe, but you're seeing a lot of progress there. I think we're going to see more momentum in the ad-supported business as their ad tech improves. But the trend here is that revenue is going up as the number of users goes up. So that's exactly what you want to see from a horizontal services business. The challenge is this company has not typically been very profitable either from a cash flow perspective. They are now generating positive free cash flow, and from a net income perspective, not been profitable when you pull out things like stock-based compensation. But what has changed here? In 2023, we saw CEO Daniel Ek and Spotify really start to realize that they have to contain their operating costs. I know this seems obvious, but a lot of these big companies are just starting to figure out that they should have a ton of operating leverage. So in the most recent quarter, sales and marketing down 18%, R&D down 4%. We don't want to see them slash R&D. We want to control those costs. So on a constant currency basis, it was up just a little bit. And then general and administrative down 19%. On top of this, in December, they announced another 17% of the staff of the company was going to be laid off. So these operating costs are going to come down even more in 2024. At the same time, price increases, which are only about $1 per subscriber, are going to be implemented in a lot of countries around the world. So again, user base going up, revenue per user going up, operating costs going down. That should mean that profitability is going to improve sharply in 2024. The market is starting to see this, but I think this is going to happen a lot faster mid-year than a lot of people are anticipating. Now, Spotify is not a cheap stock. As I'm recording, the forward price to sales multiple is 2.1, relatively inexpensive for a tech company, but Spotify isn't going to have the same 70, 80% margins that a lot of other companies do. So that is maybe a little bit expensive. Price to earnings multiple on a next 12-month basis, 117. Again, investors are not expecting a lot of profitability. So if they overshoot that, the market cap is only about $38 billion. It is very possible that that free cash flow number of around $200 million improves sharply on a quarterly basis. And Spotify, a couple of years from now, is generating over $1 billion or €1 billion, as they report, in free cash flow per quarter. I think that makes the stock much more reasonably priced than it appears right now. And a lot of the progress is going to be made in 2024 on that operating leverage and turning the growth that they've had on the top line into performance on the bottom line. That's why this is the first stock that I wanted to cover. It's one of the biggest holdings that I have, and Spotify is absolutely a great stock to own for 2024. The second stock on my list is not a very popular company, but I think could be a phenomenal investment, and that is General Motors. GM is one of those companies that just can't seem to get a lot of credit from the market despite being extremely profitable, because all of the hype is in electric vehicles, and particularly with Tesla. But I think we saw in 2023 that there's a lot of problems in the electric vehicle market. Prices are coming down as supply of traditional vehicles has gone up. Consumers have actually trended more towards big trucks and SUVs, things like that. And those vehicles are still not primarily electric, are not selling well, because a 7-seat SUV costs upwards of $80,000 if you're going to look at an electric vehicle. And that's with a Rivian that's not even the size of something like a Tahoe. So we also get into regional markets where there's a ton of EV sales in California and certain places in Europe. But I live in the Midwest. There's not a lot of electric vehicles here. There's a ton of sales of General Motors vehicles. So I think this is an area where the market is not giving General Motors credit for being the strong company that is. I'm just going to go through a few of these metrics right now. Price to sales multiple on a trailing basis is 0.84. Price to earnings multiple is under 5. On a forward basis, the price to earnings multiple is 5.1. This is before the most recent quarter, the fourth quarter, when GM bought back almost 20% of its stock in a single day. They had a massive buyback program. Some of those buybacks are going to be continuing for the next couple of years. But on a single day, they bought back about $7 billion worth of stock. That's a ton for a company that's worth less than $50 billion today. And I think that gives investors both value and optionality. As most of the investment in the auto industry goes into building out electric vehicles, something that General Motors is playing a part in, there's less investment going into vehicles like trucks, SUVs, and generally internal combustion engine vehicles. That's not where R&D and capital expenses are going. But guess what? Most vehicles sold today are still internal combustion engine vehicles, and the most profitable vehicles sold today are trucks and SUVs. That's where GM dominates. That's where the cash flow is coming from. And I think it's going to take much longer to get to electric vehicles in a lot of these markets than a lot of people realize. Traditional ICE vehicles are going to be very profitable for decades to come, just like we're going to be spending money on oil and gas for decades to come. I think that's just the reality of the business. It's a little bit like buying cigarette stocks in the late 90s. It was very unpopular, but ended up being fast market outperformer. The great optionality with General Motors is its majority ownership of Cruise. Now, if you followed Cruise at all, and this is a company that I've covered here on Asymmetric Investing, Cruise ran into a lot of problems in 2023. It's actually shut down right now because of an accident that happened in the San Francisco area. The accident itself wasn't Cruise's fault, but it brought up a bunch of safety concern. So General Motors is doing a full review of Cruise. I think eventually they will get those vehicles, those autonomous vehicles, back on the road, and there's a lot of optionality to grow that long term. But buying a company like GM at a price to earnings multiple of 5 and getting that Cruise business basically for free is great for investors. So I think GM continues to sell a ton of trucks and SUVs, continues to buy back stock. And in 2024, the market is going to realize that maybe ICE vehicles are actually going to be more profitable than electric vehicles, even for the market leaders. That's why this is the second stock on my top stocks for 2024. Before we get to the third stock, I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insights and stock recommendations to investors of all skill levels. If you watch this channel, you know how much I love researching stocks and trying to find the next great investment. So I'm proud to partner with The Motley Fool to bring you their top 10 stocks from their popular Stock Advisor service. Now, why should you care about Stock Advisor? Well, Stock Advisor is a service that is beating the market. As of December 7, 2023, it is up 509% versus the S&P 500's returns of 133% over that period of time. So nearly 4x the returns of the S&P. Just a phenomenal track record. So if you want to see their top 10 stocks to buy right now, go to fool.com/ASYM. There's a link to that in the show notes, and it's on the screen here as well. It also really helps support this channel. So when you're done watching this video, that would be the place to go next. The third stock, if we go back to the horizontal business models that I like, is Peloton. Peloton is a company that has made a huge shift over the last few years from selling bikes to people at home, having a premium service, to wanting to be the fitness company that's doing anything, anywhere. So it's no longer just a bike company. It's not just bike classes. If you go into Peloton or you sign up for their app, you're going to get access to almost 20 different, what they call modalities or types of workouts. You can do yoga, you can do meditation. There's outdoor running. There's all kinds of content. And the price for an app subscription to Peloton is going to be a tenth of what it costs to have a subscription to a lot of gyms, especially if you have more than one person in your house. So the opportunity here is to start with the 3 million people that are already subscribers and increase that potentially 10x over the next decade or so. Reach more and more people, and then every single class that you're producing, you can distribute that to every single person that is subscribed. It's a lot like Netflix and the way that their business model works, producing a piece of streaming content and then being able to distribute that to hundreds of millions of people around the world. I don't think the opportunity for Peloton is having hundreds of millions of subscribers, but if this company had 10 million subscribers, it would be incredibly profitable and the stock would go on an absolute tear. I think there's going to be bumps along the road, but we are seeing progress in that direction. I want to just show a couple of things from the most recent earnings report to just show what you should be looking for in 2024. This is the most recent quarterly report from Peloton. You can see a few trends here. I just want to highlight the member trends. They're actually moving in the wrong direction. This is partly because of the way that they've changed their app subscriptions. This is the app subscriptions at the end of the first quarter of fiscal 2023, and then the most recent quarter is actually first quarter of fiscal 2024. A little bit confusing the way they do their annual year. But this is actually what we're going to want to watch in 2024 is, do they have momentum here? Because these subscribers on the top, the connected fitness subscribers, that's actually the people that have bikes and are just paying that monthly fee to have a bike. I'm in that group, but the way that you want to see this business expand is the people that don't necessarily have a piece of Peloton equipment, but have a subscription to their digital content. So that's the member numbers to keep an eye on, but the revenue numbers to keep an eye on is subscription revenue. $415 million in subscription revenue in the most recent quarter. That was up slightly from a year ago. And then if you're looking at subscription Revenue, you also want to look at subscription profit. And again, $279.7 million in gross profit from subscriptions. That was up 3% from a year ago. So where is Peloton losing money? Well, it's losing money on selling physical products. Made a tiny bit last quarter from a gross margin perspective, but most of their margin is going to come from the subscriptions that people are paying on a monthly basis. So that gets them to gross profitability. They just have not gotten to the point where they're able to cover their operating costs. So as you see, the operating cost numbers come down and the gross profit numbers go up, we will eventually see Peloton get to profitability, or at least that's the theory. And if that happens, I think the momentum for the stock will be absolutely tremendous. It's a little bit like Spotify in the way that the financials should work, and we should see progress in 2024. It's just starting from a little bit of a worse position. Now, this is one of the companies on this list that does not have a phenomenal balance sheet. This is a look at that here, $748.5 million worth of cash, but there's also a significant amount of debt, $989.1 million in convertible notes, and then a term loan of $671.2 million. So they're getting to the point where the cash flow number is improving, getting closer to break even, but they are not yet profitable and do have a significant debt load on the balance sheet. So need to see these financial numbers improve pretty quickly. But if they do, there's a lot of operating leverage for Peloton. This is definitely more of a higher risk company, but it's definitely higher reward as well. As I'm recording right now, Peloton's enterprise value to sales ratio on a trailing 12-month basis is 1.3. Enterprise value to free cash flow on a trailing 12-month basis is just 11. So if these trends continue both on the revenue side, growing those subscriptions, and like I said, I think we haven't seen that really take hold yet, but that's something we need to watch for in 2024. And if those operating costs continue coming down, that's why this could be a phenomenal stock next year. The fourth stock, just don't overthink it. Alphabet, phenomenal company. The search engine continues to churn out cash, not losing any market share to Bing or artificial intelligence or chatbots. You have tailwinds from businesses like YouTube, which continue to grow. And I think that's going to be a dominant force in the next generation of streaming. And then there's optionality for businesses like Waymo. I mentioned Cruise earlier with General Motors, but Waymo is actually still on the roads and is still scaling their business. I think there's a lot of potential for that business to be very disruptive. And while Alphabet stock isn't cheap, I think it's got a reasonable valuation. Price to earnings multiple on a trailing basis is a little over 26. On a forward basis, it's 21. And Alphabet over the last 10 years has got a compound annual growth rate over 18%. Sometimes investing is simple. Just buy the best companies, the products that you use every day. I think Alphabet and its suite of products lives in that category. There's a lot of potential for growth. I didn't even mention artificial intelligence and all the work that they're doing there, but that's another area that we could see growth. So I think there's a lot going for Alphabet. Always challenges when you're a big company like that, but this is one of the cheapest of the Magnificent Seven stocks, and I think it's actually one of the best performers from an operating perspective. The fourth stock, I'm going to get a little bit more wheezy. That is Portillo's. Portillo's is a restaurant company known for hot dogs and beef sandwiches. And if you live anywhere near a Portillo's, you know that it is known for having long lines, whether you're in the store or going through the double lane drive-through. There's only about 80 locations, but management is expecting to grow the number of locations at 12 to 15% per year. And the economics behind each of these locations is just phenomenal. If you look at Portillo's revenue per restaurant, and this is one of the best metrics to look at in the restaurant business, Chipotle, Cava, Sweetgreen, you're looking at a little less than $3 million per restaurant. Shake Shack, you're looking at more like $4 million per restaurant. Portillo's average restaurant, $8.8 million, and also generating in restaurant level EBITDA margins of about 25%. So that means that each Portillo's restaurant generates about as much EBITDA, or as a proxy for cash flow, as every single Chipotle restaurant generates in revenue. That is just a phenomenal statistic for this company. And while there were 84 locations expected to be completed by the end of 2023, you can see that there's a lot of opportunity for expansion. Most of their locations are in this, what they call the Chicagoland area, Illinois. As you look at this list, just a ton of restaurants in that area. A lot of them opened way back in the 60s and 70s. But their expansion is into the Sun Belt area. They've had a ton of success in Texas and then also in parts of Arizona. And so they're going to be expanding in this area That's where that 12 to 15% unit growth is going to come from. So a phenomenal restaurant growth chain that is really, really early in their growth phase. Now, Portillo's isn't cheap, but it's also a growth story. If you remember back in the mid 2000s with Chipotle, when they were in their growth phase, the company wasn't generating a lot of profits because they were pouring most of the money that was generated from each restaurant back into expanding to more and more restaurants. Eventually, you start to get operating leverage as you both get costs down with new restaurants and with having more efficient supply chains. And then also as you spend less of that money on expansion, now it starts to flow to the bottom line. So right now, price to earnings multiple on a next 12-month basis is about 38. Enterprise value to sales on a next 12-month basis is about 2. But remember, Portillo's only has about 80 restaurants, and management thinks that there's a potential to potentially 10x that, 12 to 15% unit growth combined with single digit same store sales growth. You're talking about a company that could grow 20% or more for really the foreseeable future. And if, like Chipotle, they grow for 20% or so for 10 or 20 years, this will be a phenomenal restaurant stock to own and just sit and hold it. That's what I'm doing with Portillo's. And I'm looking to buy more if the shares pull back, because I think when you hear people that enjoy Portillo's, this is like a cult following, a lot of similar to the way that Chipotle was 15 or so years ago. So that's why this is my top restaurant stock for 2024. Another growth stock that I see phenomenal things from this year is On Holdings. So this is the company behind the On brand. You may see these shoes around more and more, but they have been on an absolute growth tear over the past few years. Came public recently, relatively new brand and relatively small, but the growth story and potentially even the value story is just too good to ignore. This chart shows On's growth compared to Nike, so one of the leaders in the sports equipment business. And you can see that On is growing much, much faster than Nike, 46.5% in the most recent quarter. Management expects to grow at an over 30% compound annual growth rate through at least 2026. And you can see that growth at Nike has stalled out, basically not growing anymore at all. They're a little bit positive. And then look at the price to sales multiple. So On Holding, despite growing significantly faster than Nike, trading for a price to sales multiple of 4.1 compared to a price to sales multiple of 3 for Nike. On top of that, On has even better margins. So this is a look at gross margins, and On is expecting gross margins to be around 60% for the foreseeable future. They really don't discount their products the way that Nike does. They're not trying to build as big a business necessarily as Nike. They're trying to stay in that premium segment. And so they've maintained very consistent margins. And despite growing as quickly as they have, they've maintained profitability as well. That's extremely difficult to do because you're trying to manage inventory, build out those growth channels. You have to invest in sales and marketing. Typically, companies that are growing extremely quickly, especially companies that are making a physical product, have a really hard time also generating net income at the same time. Usually that's a lagging indicator. It comes often years behind the growth that we see. But with On Holdings, we're seeing not only phenomenal growth, we're seeing growth on the bottom line and profitability on the bottom line. So you consider all those things and the fact that it's trading for only a slight premium to a company like Nike. I think On Holding is going to have a phenomenal 2024, and it's the kind of stock that I'm just going to hold for the foreseeable future because I see a very bright future for that brand. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The 7th stock to cover is Airbnb. Now, this has become one of these companies that's becoming a verb. Even if you're not actually using Airbnb, the app, a lot of people who are talking about short-term rentals are just using the word Airbnb. So that's an incredibly powerful position to be in the market, especially a market that's a two-sided market. If we look at some of their metrics, it's just phenomenal how well this business is doing. This first one is a look at the gross booking volume. And you can see this has grown from just $8.1 billion in 2015 to $71.3 billion over the last 12 months. The great thing about this is when somebody books with Airbnb, they actually make a deposit. Airbnb gets to keep that cash. And so this is a look at the cash balance. The left column, or the orange column, $11 billion in cash and short-term investments, that's Airbnb's money. But the $6.1 billion is primarily deposits made by customers. Now, Airbnb gets to invest that money in things like treasuries, very low risk, but it gets to generate a rate of return. So with interest rates rising to about 5%, there's $17 billion worth of cash sitting on the balance sheet. That's going to generate getting close to $1 billion on an annualized basis just in interest from the cash on the balance sheet. So that's a phenomenal position for Airbnb to be. This is also a growing business and a profitable business, a free cash flow positive business. So if we look at some of their multiples right now, price to earnings multiple on a trailing basis, 16.3. Enterprise value to free cash flow is about 26.7. Not necessarily a cheap stock, but given the company's growth trajectory and the fact that you have this phenomenal balance sheet that could be used to invest in more products built internally, could make acquisitions, could also just buy back shares. I think Airbnb is in a phenomenal position. We need to grow into that valuation a little bit. But if your time horizon is 10 or 20 years like mine is, I think Airbnb is going to do extremely well on the market. And the next stock is MGM Resorts. This one is a little bit different than the other ones that I've talked about. This is an entertainment and casino company. Their primary operations are in Las Vegas. They own about half of the Las Vegas Strip. Don't actually own the casinos anymore. That real estate is now owned primarily by Vici Properties. So it's a real estate company. They sold a lot of that land to, and actually the buildings, and they just pay rent for that. The great thing about that is they sold at a very opportune time when interest rates are much lower, got cash, and bought back a lot of stock. Their second primary place of generating cash is Macau. They have 2 resorts there, own a little bit more than 50% of that subsidiary. And then their third operations that is going to be opening around 2030 is going to be in Japan. That's being built right now, about a $10 billion casino, and they'll own about 40% of that property. So you combine all this together, and I think what you have with MGM Resorts is a leader in entertainment at destinations that people are going to be going to. With all the people who are working with people around the world in remote offices, we're going to have more and more people needing to get together to meet, to do work, to have an entertaining vacation. Where are you going to do those things? I think there's going to be more and more hubs that are built specifically for this. Las Vegas is clearly one in the US. Macau is clearly a place to do that in Asia. In Japan, I think Osaka has the chance to do that as well. So I love the tailwinds behind the business. We're also exiting the investment phase. If you go back to even the 70s and 80s, Las Vegas has been in a building boom. But MGM Resorts isn't building casinos anymore. They're not building new properties because most of the prime real estate has actually been built out, and a lot of it is now owned by MGM Resorts. So they're really in a cash generation phase of the cycle. That's what I really like about the business. Same thing goes for Macau. If you look at the business, enterprise value to sales is about 3. Price to earnings multiple on a trailing 12-month basis is just 15. And the free cash flow per share was $4.01 over the last 12 months. So with shares trading at about $44 per share as I'm recording, that means that the cash flow per share is almost 10% of the share price. They could do a number of things with that. They could continue to buy back stock. They could pay a dividend. They're going to be investing in that resort in Japan. But I love the fact that you have a positive cash flow business today, and there's a lot of room for improvement in the future. Macau still has not fully recovered from the pandemic. We will see where that goes in the future. There's a lot of questions around China. I think there's still growth potential in Las Vegas. Las Vegas had an absolute phenomenal recovery from the pandemic in 2021 and 2022. Things have slowed down just a little bit, but I think long-term, the trajectory is still going to be higher there. So MGM Resorts, I think the tailwinds are the entertainment business and having a huge presence in the hubs, and then both the hotel rooms and convention space, as well as those monetization options like clubs, like restaurants, and like that casino floor. That is a phenomenal business to have long-term, and that's why it is one of my top stocks for this year. Number 9 on the list is another recovery play. That is Zillow. So Zillow has suffered from a couple of things over the last couple of years. It got out of the iBuying business. That was a business where they were trying to buy homes, basically flip them, become essentially a market maker in the home business. But that did not turn out to be very good business for them. They got out effectively unscathed because they got out before the market started to go sideways over the last few months as interest rates rose. So now they're focusing on being the platform company in real estate, connecting particularly real estate buyers with real estate sellers and those selling agents. The way that they actually make money is through those agents paying a fee to be connected to buyers who are interested in buying a home. But the advantage that Zillow has is it's a go-to place to be looking for homes. And I think that gives the company a lot of optionality in the future. If people want to just start directly listing their homes on Zillow, that's going to be something they're going to be able to do. We had the collusion lawsuit with the National Association of Realtors. So the realty industry may actually be changing over the next few years as well, because that tie between buyers agents and sellers agents may start to break down. So what platform do you have if the current infrastructure starts to break? Well, Zillow is the natural answer to that. So they can connect buyers and sellers with each other, can connect buyers with mortgages, with insurance, with all of the things you need to do to buy a home. So this is really a platform company in the making. And I think we're only scratching the surface of the potential. The company's market cap right now, $12.6 billion, and profitability isn't very good because we are in a down point in the market. So realtors aren't going to be spending the kind of money that they were during the peak boom days of 2020, 2021, trying to connect with buyers and sellers. So that's why that basically advertising piece of the business is starting to go down. But what is growing is the rental business. So they're connecting people who are looking for housing with rental properties. That's another piece of the growth platform that Zillow's building. And that is growing really nicely. And I think before too long, we're going to see the housing market start to recover as well. Transaction volume is really what's going to drive Zillow's business. But long term, the optionality to be the platform people go to buy and sell homes is really going to be the upside for Zillow. Solid balance sheet with $3.3 billion worth of cash, offset by about $1.1 billion, offset by about $1.7 billion worth of debt. So given the company's market cap and cash on the balance sheet, still a positive net cash value. But I think ultimately the investment here is in the housing market and the way that we do transactions just fundamentally changing. Instead of having to go to a realtor to access the market, I think 10, 20 years from now, we're going to be going to Zillow first. And this is really the only platform play in real estate. That's why I love this company. May take a long time for this thesis to play out, but I'm here for the long haul. Like I said, 10, 20 years is my time horizon. That's why I love Zillow right now. And the final stock is again kind of against the grain. That is Verizon. I just think there's too much value in Verizon shares, too much cash flow coming into that business. People are not going to stop paying their wireless bills. And Verizon is starting to get into new markets. Fixed wireless was a huge growth market in 2023. I think that will continue, although growth there may slow a little bit. They're raising prices in certain areas. Free cash flow is improving. Debt is coming down. So a lot of positive trends for Verizon's business. You can see in this chart that the last year has really been a sharp improvement in Verizon's free cash flow. There are a couple of reasons for that. One is there's less investment going into the ground with the build out of the 5G network. So a lot of that investment happened between 2020 and 2022. So now the money going out the door is starting to slow down and the money coming in the door is improving as operating cash flow improves. So $7.7 billion in free cash flow over the most recent quarter. That should tick up a little bit higher on a quarterly basis. And if you think about that run rate, that's close to a $30 billion run rate for free cash flow. The current enterprise value is $340 billion for Verizon. So there's a lot of questions for this company because telecommunications is fundamentally very expensive to build out. But I think what we're going to see in the future is that the competition between the three major suppliers in the US is going to really reach an equilibrium. Prices are going to increase slightly. The number of connections is going to increase. That's what they're doing with things like fixed wireless. And then they're going to add things like streaming to bundle services. So they get a small cut or fee from those streaming services when they sell those through your wireless connection. Those are all going to help Verizon's cash flow. So in 2024, I think the trend is going to be that free cash flow improving just a little bit, Verizon reducing debt to reduce the risk to the balance sheet. Remember, as interest rates rise, that becomes more expensive if they have to refinance that debt rather than just paying it down. And as they reduce that debt, then some of the value is ultimately going to turn into equity that will push the stock price higher. Right now, price to earnings multiple is just 8 on a trailing basis and 8.7 on a forward-looking basis. So I think there's a lot of value there for investors. And on top of it, the current dividend yield is 6.8%. So you're getting a great dividend, a very sticky product, It's not very loved by the market right now. And I think that's pretty understandable, but just given the valuation, the value in shares, I think even if we're just getting the dividend for 2024 and the stock doesn't go anywhere, this could be a market beating investment. So those are the 10 stocks that I really like going into 2024. Just to recap, we have Spotify, General Motors, Peloton, Alphabet, Portillo's, On Holding, Airbnb, MGM, Zillow, and Verizon. Those are the 10 stocks that I like for the year. Don't forget to follow this channel, Asymmetric Investing, on YouTube for all my content throughout the year. These are definitely going to be 10 stocks that we could be covering quite a bit. And let me know in the comments what you think about those 10 picks. Which is your favorite? I'd love to hear your input. Thanks for watching, everybody. See you here next time.